So thank you everybody for joining today. We have an enormous amount of attendees today. I'm going to start sharing the presentation in a minute or so. I like working off of our presentations because it provides you with something to take home. The presentation that you'll see today is going to be sent to you, so you have a copy of it and you can see what we put together. As most of you already know, the new Fannie Mae and Freddie Mac lending guidelines for condominium and cooperative developments went into effect on September 18th, just a couple of days ago. We knew these new guidelines were coming because Fannie Mae and Freddie Mac had released the guidance all the way back on July 5th. And during that time, we've had an ample amount of time to review them and to outline what the impacts are for the industry. So a couple of cleanup items before we launch into this. Firstly, we are happy to answer as many questions as you have. So we ask you to please utilize the chat feature or the Q&A feature. We check both. Any questions that are asked, we're going to try and provide an answer to everyone, and we're going to try and do that at the end of this presentation. We have a lot of material to go through, so we may have to defer and send you the answers to those questions or the most important questions that we have, or answer them individually. But we usually pick out the most important questions that we think are impactful for the whole entire group and send you the answers to those as an FAQ. We're going to run about 30 minutes today. We might run a couple of minutes over. And if we run a couple of minutes over, I apologize up front. But this information is really, really important. So, but we try and keep to 30 minutes just to make sure that you're very well aware of what's happening in the industry. So let me start sharing this presentation for you. So obviously, Condotek, this is our the company that has provided most of the guidance in the industry as it relates to residential mortgage financing for condominium and cooperative developments. We spend a lot of time looking at the available products and programs, not only from the agencies, but also from secondary market investors, and what you have available to you in the area in order to provide residential mortgage financing easily to purchasers and borrowers. That being said, I'm Orest Tomaselli. Again, I'm the president of project review here at Condotek, and I regularly, educate the industry in condominium lending guidelines and cooperative lending guidelines. So a little bit about Condotek, because we always provide a couple of minute outline on Condotek. We have two main products in the industry: the Condo Pack, which is our documents only delivery, where lenders order a condo pack from us and we provide questionnaires and all the related documentation for review for condominium developments that lenders need in order to make an appropriate decision internally regarding warrantability. We also offer the condominium project warrant, or the condo project warrant, the CPW product line, and that is a service by where we actually provide all the documents and the review. And a lot of the people who are on this presentation today utilize our CPW product because we provide a warranted review of that specific condominium development for the specific agency type of review that you choose, whether it's Fannie Mae or Freddie Mac. And in some instances, we even have portfolio product lines available that we will warrant to. Those are from secondary market investors that are offering these products in a bespoke fashion for certain lenders. Very important for everybody here to know. So we've been incredibly successful with our product line because it's so automated, because we pull this data from multiple resources, it's a consistent data package and a consistent decision, which is so hard to find in the industry right now. And it's a really high quality review. We're incredibly risk averse, but we want our lender clients to close transactions. So we will do everything we can in order to get the right information regarding warrantability of condominium and cooperative developments, because we do provide a life of loan guarantee that it is warrantable. We're going to talk about that a little bit today too, about what's going on in the industry and warrantability in and of itself. So Fannie Mae and Freddie Mac, as I said earlier, but a lot of people weren't on, have ratified their temporary guidelines. And there's been a lot of changes over the last couple of weeks. The first major change that we have is that September 18th was the magic date. The guidelines went into effect on September 18th. So now we're, fully in the middle of these new lending guidelines for condominium and cooperative developments. What happened was Fannie and Freddie issued temporary guidance, post Surfside. Although it's been said that the reason for the guidance or the changes in the guidelines wasn't as a result of Surfside. So there's a little bit of confusion there for me. But these guidelines are very, are very different than what we've experienced before in the last decade or so in order to lend into condominium cooperative development. So these temporary guidelines that were issued a couple of years ago, with this new guideline change and the implementation on September 18th, these guidelines, most of these guidelines, I should say, were made permanent. So there are a couple of changes, but not many. But we can see that the focus is still the same, and that focus is really almost entirely on the aging infrastructure of condominium and cooperative developments across the country. And we're going to delve into that in a minute too. So before I move on, it's important to understand that the implications of these guideline changes aren't really just impacting, conforming loans or jumbo loans, or say not just conforming loans, but also jumbo loans and non-warrantable mortgage lending and portfolio mortgage lending, where these new guidelines, because I think in many ways the agencies hit this, right on the head. I think they really made the right decisions, in the issuance of these guidelines for a lot of reasons that I'll go into. I know that may not be a popular opinion right now, but I think it's important to understand that there are a lot of problem projects in the industry. But the point I want to make is that there are implications for lending in condominium and cooperative developments for every channel, for every type of loan product, due to the changes that were made by Fannie Mae and Freddie Mac. So if you have a building that doesn't comply with Fannie and Freddie guidelines, it is becoming incredibly difficult for a secondary market or to find a secondary market investor who will provide, or provide you with a resource for closing that mortgage. And that's really important to know. That's important not only for existing established condominium projects, but also for new construction projects. And I'll delve into that in a minute. So these guidelines are very purposeful and very specific. And again, the focus is almost entirely on the aging infrastructure of condominium and cooperative properties. But there's like a split focus. As a result of the focus on the aging infrastructure, there's an entire focus here on making sure that homeowners are protected. And I like that. I like the fact that the spirit of these guidelines is not only to make sure that good loans are provided or insured by the agencies, but also that homeowners are protected. And I'm going to give you a couple of instances today where homeowners were not protected, and things that were caught that not only we've found, but that are becoming industry stories, in reviews of these condominium and cooperative developments, and how difficult it can be to, own a unit within a condominium development that hasn't spent the time focusing on the repairs and maintenance that is necessary and hasn't spent the time ensuring that their financial health and financial house, so to speak, is in order. So we're almost entirely focused on the aging infrastructure of these condo and co-op properties, right? And there are protections put in place to ensure that the financial and physical health of homeowners and purchasers is there for condominium owners and purchasers. And what that boils down to is there's this major analysis that now has to be performed on the structural and mechanical component condition of a condominium property. In fact, it's mandatory. In fact, if you can't make a determination on the health of the property, of the physical components of the property, and you can't ensure that the physical components and structural components are compliant or not, you have some sort of critical issue on them, you can't approve the loan and or the project for mortgage financing. So as a lender, you have to essentially mandatorily review condominium developments and make sure that they meet the standards that were set forth within these new lending guidelines. And if you can't get an answer to a question, if you can't find corroborating evidence that states that the property is in good physical condition and financial health, then you can't close the loan. And I think that's what the industry is struggling with right now. And there are very few resources to close loans in projects where you can't find those answers. And some are worse than others. I think the answer that, or what I really want to outline to you today is that as an organization at Condotek, we see thousands of condominium developments and we review thousands of condominium developments each month. And what we found is that, the news is not all that bad. There are well-managed, really well-funded, properly maintained condominium and cooperative properties that exist in this country. And many of them have operated, their boards and property managers have done a really good job in making sure that not only are they up to state code and not only are, and that their components are essentially well maintained, but they've set aside enough capital to ensure that they have enough reserves in their accounts if something does go wrong in the future. So that's really important to know. There's a lot of good properties out there that we find. And the same rule still applies. And I always give this percentage, and it's kind of holding true. Around 70% of the developments that we see are compliant with agency lending guidelines. Around 20% need a little bit of work. There's something wrong with them. There's something that we can't get them to comply one way or another on the first go around. But eventually, with a little bit of work by the association or the manager or making some changes, those projects can be compliant and are mortgageable. And then there's this leftover 10%, and it warbles between 5 and 10%. We found probably 5%. And I make the joke all the time, I wouldn't lend them $5. And the other 5% you just can't get data on. So therefore they are non-compliant. So important, specific and purposeful guideline changes that came out. So what are the key guideline changes? First of all, a lot of these temporary guideline changes became permanent, as I've outlined, and some didn't. So there's a focus on property condition. What the agencies want to see, and what is a really good position to take, is these guidelines focus on ensuring that condominium developments have amassed reserves. In the past, it was okay if you had a 10% line item in your operating budget for reserve. And in many instances, the balance, years ago, we never even asked the balance of what was in that reserve account. Many underwriters across the country never asked how much cash was sitting in that account. It wasn't a requirement. And now we need to know. We need to know exactly how much is in that account, how it got into that account, meaning is, did it get in via the budget? How they've been spending that money and making sure that they've been doing the appropriate repairs and maintenance to the components in those condominium cooperative properties. We've seen a surge right now in reserve study utilization. And as an organization, at Condotek, we see a lot of different reserve study reports, and not all reserve study reports are created equally. However, the good ones that we've seen out there provide a property condition analysis on both the structural and mechanical components. And you could hang your hat on the fact that if it's a good reserve study, a professional engineer was at the site, did a visual inspection of the property. They're trained in understanding what is a structural issue, what is a mechanical issue with a component. And when you delve into some of these reserve studies, you could clear a lot of the issues that come up within a project review. So we're big proponents of the reserve study. We're big proponents of getting a reserve study and performed by a professional engineer, and utilizing that reserve study to essentially warrant condominium developments and cooperative developments, as long as they're less than 3 years old, of course, because that's the guideline. And we see a lot of condominium developments across the country essentially updating the reserve studies as a result of the guidelines. So it's a great tool for us to utilize. Critical repair completion has also been, an issue that's, come up within these new guidelines. So any critical repairs that you find in these properties, or that you're made aware of through violation search or through a questionnaire, those repairs have to be completed as per the new guidelines prior to any mortgage financing being available in that site. And Fannie Mae and Freddie Mac kind of aligned on these lending guidelines for the first time we've seen in a while, where in fact they're doing joint presentations on these new guidelines, which we were really happy to see as well. They're kind of rowing in the same direction. There is a heightened focus on insurance deductibles, and I'm going to go into insurance in a second, and reviewing almost entire policies. And there has been an issue there that we've started to be able to solve, where in some states insurers will not provide some information, and we've been struggling as an organization to get the appropriate information to make a determination on some of these properties, so you could close your loans. And it's become a difficult path, but we're starting to break through a little bit. And we're starting to break through because these guidelines are starting to get out into the industry, and insurers are starting to figure out that, they must provide some of this information. We're not there yet, but I think we're going to get there soon. Obviously, the new guideline changes re-ratified the fact that there is, an unavailable designation that's issued by Fannie Mae. That unavailable designation prohibits any project that has that designation, or any condominium development or cooperative development, from getting conforming mortgage financing through Fannie Mae. Most other agencies align with that list. If a condominium property is on Fannie Mae's unavailable list, it stands to reason that in most instances that that loan won't be saleable to Freddie Mac either. And there are some, there are lots of properties that have been added to this unavailable list, or have this unavailable designation. Across the country right now, there's close to 2,200 condominium and cooperative developments on the unavailable list, or that have an unavailable designation. And that's important to note, because that's one of the first things originators should check. So that guideline has now become permanent. There's also new guidelines regarding entering in full review condominium projects into Fannie Mae CPM, or Condo Project Manager. I'm going to return to that in a minute too, because we think that that's the future of condominium lending, and we're so happy that this is now being done, because Fannie Mae actually provides an approved designation essentially for some projects that are in CPM, and I think that list is going to get bigger over time. We're obviously still having problems with this, questionnaire addendum. There, within these new ratified guidelines, the new addendum questions that were added to the questionnaire have to be answered. These questions are primarily on the structural and physical condition of the property. And we're still seeing some pushback in the industry where a lot of property management groups or attorneys that represent these boards are not providing the answers to these questions. They're leaving them blank. And again, as I said earlier, if you can't answer the question, and if you can't determine compliance, then that project is unwarrantable, or that loan can't be sold to the agencies. You have to be able to answer the appropriate questions regarding condition, structural and mechanical condition, and a lot of others as well that come as a result of that addendum to the condominium questionnaire. So that's now fully in place in the new guidelines. There's also new guidelines that are impactful on special assessments. Obviously, if when you have many communities across the country have special assessments, and special assessments aren't always bad, but there are communities that operate entirely via special assessment. And that's a problem. They have no amassed reserves, they have no money in their accounts, and it could become a financial burden for the homeowners. But why there's a focus there is often when you have a special assessment that is required from every single unit owner, not only can it cause a financial burden and a financial struggle for the unit owners, but it also sometimes identifies some critical repairs that are incomplete, and the size of these special assessments can grow very large. So the agencies have put some guidelines into place around what the maximum special assessment is, or regarding warrantability. Whoops, we just lost my screen for a second. Apologize. Let me pull that back. Whoops. One second. So I can.
We're still able to see the presentation, Orest.
All right. So the only problem is I am not for some reason. So let me pull that back into the appropriate place. Apologies, just give us a second with this technical difficulty. All right. Wouldn't mind, give me 1 second and I will pull this up.
And just so everyone knows, we will be sending out an email after the presentation with the recording and all the slides. So you will have access to all the slides. I know that question came up.
So give me 1 second. I'm going to stop sharing and reshare. I think it's the easiest way to do this for everybody. Okay. There we go. Apologies for that. Melinda, you can see the screen now? Melinda, you're on mute.
Yes.
Okay, thank you.
We are all set and we should be on slide 7.
All right, fantastic. Sorry about that. So again, special assessments, let's just jump back to this. One of the key new lending guidelines is that unfunded repairs, if you have a special assessment that has unfunded repairs as a result of that special assessment, like let's say you have a community that filed a special assessment to all their unit owners in order to make sure that they're repairing a boiler or a roof or whatever it may be, and that roof is not complete. It's an unwarrantable project. And technically you can't have repairs that or special assessments that are equal to more than $10,000 per unit. And if you do, it's you have to essentially prove the point of essentially make sure that you have completed the repairs, and or you have enough capital sitting in your account outside of the special assessment in order to make those repairs. So there's a couple of overlaying requirements here that are important to understand. Special assessments is a new category of review that we really have to pay a lot of special attention to make sure these projects are warrantable. So anyway, moving forward, because I really like to make sure we stay on time. What I love about these new guidelines, and I thought was really impactful for this conversation to discuss, is that, Fannie Mae's CPM and Freddie Mac's PAR system, um, you know, are fantastic right now. It's at the infancy of what I think they're going to be, but essentially what you are able to do is you're able to go into these specific systems when you're after you've originated a loan, put the project in, and make, the agencies will have provided a determination on some sites that these projects are either, acceptable, in Condo Project Advisor and both CPM, that that the agencies have reviewed these projects before, and that there's some level of acceptability. And what that does is it provides a project certification to the lender, but more importantly, there's minimal underwriting that has to happen if those condominium developments are in these systems as approved and or project certified. So lenders are going to have to spend a lot less time and underwriting the large aspects of these developments. However, there's an asterisk here, and the asterisk is specifically about insurance and deferred maintenance. So even if these properties appear as approved in the CPM and or PAR system, lenders have to do an insurance review and a deferred maintenance review of the project. So it's not like you could put the condo property in the system or put the address in the system and it comes back approved, fine, you can close the loan right away. We're not there, and I don't think we'll ever be there. Because you have to go into that project and still look at the questionnaire or ask the appropriate questions about that specific property regarding deferred maintenance, any critical repairs that are necessary. You have to look at their insurance policies to make sure they're still eligible for mortgage financing or compliant with the agency lending guidelines. You're still required to do some review to determine eligibility. And I think that's a lot of lenders kind of miss that fact or miss that point about these new lending guidelines. There's still some work that has to be done to ensure compliance and ensure that you don't have a repurchase. So there's less documentation required, which is fantastic, but there's still a review that has to be performed on each one of these developments if they are in fact approved in the CPM and or PAR system. So good news there. Next is condo and co-op insurance, and this has been the bane of most lenders' existence for the last 3 to 6 months, and in some instances even longer. So there are some trends that are happening right now in insurance compliance, and I thought it was really important to outline these to you. The guidelines specifically state that high policy deductibles over the 5% maximum permitted are all over the industry, and there's a reason for that. So we're seeing, especially in certain states like Florida, California, and even in states like mine, like in New York, where boards are being faced with huge surges in cost to insure their properties. And when I mean huge, I had a conversation with a client the other day, and it was a property manager and board on a property they were trying to get approved for Fannie and Freddie mortgage financing. And they were outlining that their insurance premiums last year were around $80,000 a year for this community. It's a waterfront community, 162 units. And at the end of last year, they surged to $250,000. And the new premium for 2024, the upcoming year, is over $450,000 for the community. So, I mean, those are astronomically high numbers. Even if you divide it by 162 units, you're still seeing a large increase in maintenance costs for the owners in that specific development. So What's happening is, in order to defray the cost of the insurance policy, a lot of these communities are being told to increase their deductible. So if a catastrophic event, happens, we've seen deductibles that are $1 million or $2 million or $3 million. And the problem with that is that it's pretty obvious, right? If the community doesn't have that capital sitting in their account in order to make the property whole or make the coverage whole, should there be a catastrophic event, you're going to see massive financial issues within that property. So the agencies have really locked down their policies on what the maximum deductible is. The problem that we're encountering is that a lot of insurers are just not providing the appropriate information, or not, providing it in a timely manner so that we could review those insurance policies. And that's what we're hearing back from our lenders as well. So there's some difficulty in this world right now. Specific states have an incredible amount of difficulty, like Florida, where it's very difficult to get an insurance policy, and a cheap insurance policy is almost non-existent in that state. And there are several insurers that have pulled out of insuring condominium and cooperative developments, or condominium development specifically in that state. Co-insurance, has appeared also to be more popular. And again, insurance agents are really hesitant to release insurance valuations and appraisals. And that leaves us unable to determine if the building limit is sufficient to meet the guidelines. So there's some insurance changes here that are really impactful, and we're seeing a lot of declinations, specifically because of condominium and cooperative property insurance issues. We don't think this problem is going away so quickly. We think that this is kind of the new standard for a while, and that costs are surging, as a result of inflation, and a result of some of the catastrophic events that have happened across the country. And I think everybody is just trying to get their hands around it. So I think this is a problem that's going to continue, and it's a review issue that's going to come up over and over again, especially on a state to state level. So we're nearing close to, we're just a little bit over our 30 minutes. So I just want to be thoughtful about time. And I want to provide you with a couple of solutions that we found out there. So when we have condominium questionnaires where the questions are left unanswered, that's, there's several states in the country that, have been, advised not to answer some of the questions on the addendum by their condo attorneys. When we have instances like that, we found that, if you go into their engineering reports or go into their reserve study, should they have them, or do a state-specific search on violations, or get a title report to be delivered very quickly, we find the answers to those questions in many instances of what the condition of the property is. So we found that you really need to search for, additional documentation, ask for the additional documentation up front in order to try and clear some of the loans that need to be cleared after they're originated, right? Insurance policy analysis. We found again that boards and insurers are sometimes unwilling to provide the data. What we've resorted to, I should say, is actually sending them the Fannie and Freddie Mac lending guidelines. In many instances, we have to cite the guidelines and send them the guidelines in order to get this data. This is kind of making its, these new guidelines are making their way through the industry. And we've seen this happen before over the last decade or two when we've had new guidelines come out. And it's going to take a little while, but we have found that if you send them the actual lending guidelines and you email it over to them and reference it and show them exactly where it is, that we sometimes get them to provide the appropriate information. Property violations are delaying project approvals. We found that as quickly as you can get a title report is as quickly as you can make a determination about a condominium property. In fact, at Condotek now, when you place an order for a condo project warrant, you have a choice to order a title report as well. We've chosen 3 national title firms to provide our clients with title, and they've all committed to a 10-day turnaround for title. Why is that important? Because lenders who are in the know and can choose which title company to utilize on refinance transactions, and in some cases purchase transactions, if they get a title company to deliver these violation searches quickly on these condominium developments, you can make a determination about warrantability that much faster. And for some lenders, that means the difference between closing a loan, regardless of whether or not it's through Fannie Mae or Freddie Mac or a secondary market investor, and not closing a loan, because they just don't have the data, and ensuring that a borrower doesn't go elsewhere, or try to seek financing somewhere else, and or they pull out of the deal entirely. So that service is up and active right now. You can order a title report through one of 3 title companies, national title companies, directly through our portal. There is also a case to be made for board and property manager participation in education. We have been pulling in property managers and condominium and cooperative boards into conversations, trying to provide them with webinars, so that they understand what's going on in the industry, the new guidelines that are in place, and how they have to make changes to their condominium developments and cooperative developments, and how they have to align with those lending guidelines. And I have to tell you, that's been the most difficult thing for us to do, because there has to be some sort of interest, and the interest that comes from these condominium cooperative boards often comes as a result of somebody not getting approved for a mortgage. So we've seen some lenders be really proactive, though, and this has been successful for them in sales as well, where they will target specific buildings and train the property managers in boards in these new lending guidelines. And the result has been is, if the building is compliant and warrantable, or if they got it there, through their help, that they're often referred as the lender of choice in that building to provide residential mortgage financing. So that's been a successful plan for a bunch of lenders that we've seen out there. The borrower education part of this, part of this new guideline review, is really important too. Borrowers are much smarter than they used to be, and the access to information is much easier than it used to be. So you could find out a lot of information online about a specific condominium development prior to signing a contract, and or if you're a board member or a homeowner and want to know what's going on with your particular property, you'll be able to, or you can, just by doing an online search in some instances. And again, the reserve study trend is great, because when we have a third party engineer going to a property every 3 years to look at the physical condition of that property, the components, the structural elements of that property, and providing a statement saying that the property is in good condition, or outlining whether or not there's an issue, that's worth gold for us, especially when we're doing a project review. So it's important to know. And then, what we do with every single presentation is we provide you with the links that we think are important. So the Fannie Mae Condo and Co-op Guideline Update link is here. The Freddie Mac Condo and Co-op Guideline Update is here. And of course, my favorite place to look, and I think I say this in every single webinar, is the Fannie Mae FAQ. Freddie has a great FAQ as well. I don't want to slight them. I've looked into the Freddie FAQ several times as well, but there are a lot of great answers here to a lot of the questions that have come up across the industry, specifically related to these guidelines and whether or not a project is compliant or not. And the final piece of information I want to give you is we have kind of a unique announcement today. We have been forging ahead with several partnerships in the industry, and we are finally at liberty to announce our new partnership with MGIC. And that partnership is going to be fantastic for our clients. When we do a condominium project warrant review on a condominium development, and that review passes and is acceptable, MGIC will provide an instant approval for mortgage insurance. So that's going to really speed up the process of getting some of these condominium mortgages closed. That, along with our title platform to try and speed up the process of getting property violation reviews or violation search on the properties, is hopefully going to result in review times dropping and more approvals for condominium developments across the country. So we hope you utilize them. And hopefully we gave you an appropriate amount of information in this short period of time. We ran a little bit over. And Melinda, I don't think we have enough time to answer any questions today, but any questions that were asked, please put them in the Q&A or the chat, and we will get back to you and let you know the answers to any of those important questions. So thanks for the time today. Thank you for spending this half hour plus with us today. Need to contact us for anything, need to contact us to get a condominium project warrant, or if you have a question about a specific site, our entire team is available. All you have to do is email us, and we'll try and get back to you quickly with an answer to your question that'll hopefully solve your problem. So thank you. Thank you for utilizing us. Thank you for jumping on these webinars. We want to keep them quick. We want to make them fast. We want to let you get back to work, and hopefully it was a valuable one today.